Good evening, ladies and gentlemen. We are a team from Kyiv National Economic University, and today we are pleased to present the results of our analysis on the world's largest food and beverage company, Nestle. I'm Igor, and with me here today is Nina, Irina, Andrei, and Asu. We issue a buy recommendation with a one-year target price of 90.57 Swiss francs, representing a 13.5% upside from its closing price as of 29th of December.
Our recommendation is based on the stock's undervalued market position and stable historical performance. Share price downturn in the end of 2018 caused a significant deviation from its intrinsic value, creating an attractive opportunity for a value-seeking investor. With 52-week price range of 16.4% from the average price for the period, Nestle appears to be the least volatile stock among peers. Considering the blue-chip nature of the stock, it is a good option for value investing strategy and investment portfolio risk strategy. Moreover, it is a good option for risk-averse investor. Our buy recommendation is supported by strong competitive positioning, stable financial performance, confirmative valuation outcome, and effective risk management.
Let's start with key competitive advantages of the company. Nestlé is the world's largest food and beverage company with the annual sales of 90 billion Swiss francs. It operates in 189 countries, which are grouped in 3 geographical zones. Nestlé's product portfolio is represented by 2,000 global and local brands, which are categorized into 7 product lines.
The company's corporate strategy is based on 3 core pillars. Firstly, Nestlé is increasing product portfolio efficiency by concentrating on 4 outperforming divisions: powdered and liquid beverages, nutrition and health science, pet care, and waters, which show the highest organic growth across the company and generate 57% of total sales. Secondly, selective mergers and acquisitions allow Nestlé to increase non-organic growth and boost market presence. During the last 2 years, Nestlé has conducted numerous targeted acquisitions. We expect that a $7 billion license deal with Starbucks will boost Nestlé coffee segment performance. At the same time, the company is divesting its underperforming units. Finally, to maintain leadership positions, Nestlé accelerates innovation as the main driver for success. The company had the highest R&D spendings in the industry, reaching $1.8 billion in 2017. In line with health and wellness strategy, Nestlé targets nutritional division as the main area of research, assigning 60% of all R&D budget.
The global food and beverage industry is characterized by high competition, with 20 biggest players controlling only 9% of the market. We determined our closest peer group by intersection of companies' product lines, financial metrics, and geographical presence. Our analysis shows that Nestlé doesn't have any rivals that exceed its size by revenue and market capitalization. However, we observe that Nestlé and some of its peers have a moderate or even negative revenue growth, which is explained by the influence of fast-changing consumer tastes.
The main drivers of food and beverage industry are growing population, rising emerging markets, and shift to e-commerce. At the same time, we identified major industry-specific trends, such as healthy diet, premiumization, and plant-based nutrition. We expect that the overall impact of the trends will result in a mid-single-digit growth for all product segments in the industry.
And now, let's consider the financial side of the company. We provide a positive outlook on the company's earnings with a CAGR of 2.8%, driven by focus on high-growth product lines. The decrease in administrative, manufacturing, and procurement costs will improve company's margins. At the same time, our forecast does not confirm Nestlé targets on operating profit margin and cost savings amount savings program. Additionally, the increase in ROI is supported by the increase in tax burden and the rise of total assets turnover. Additionally, Nestlé uses supplier financing as an interest-free way to fund its operations. The company achieves this aim through maintaining negative cash conversion cycle with subsequent decrease in working capital. The gap between operating cycle and days payables outstanding allows Nestlé to keep cash generated from sales longer. Driven by raising trading liabilities, working capital decrease indicates company's intensive utilization of supplier financing. Such an effective operational management allows Nestlé to allocate operational resources more efficiently.
Historically, the company has the lowest solvency ratios among peers. Nestlé's debt to equity and net debt to EBITDA ratios are more than 3 times lower than peers' average. This indicates that the company has a room to increase its financial leverage without taking extra risk on its financial stability. The ability to raise debt can support the company's future M&A activity and the ongoing share buyback program. Nestle uses share repurchases as a way to improve its investing attractiveness and optimize dividend payout. The decrease in total number of shares outstanding provides higher profitability per share by increasing earnings per share. It also influences dividend payout, creating a room for further increase of dividend per share in line with the company's payout strategy.
Nestle's stable financial performance leads to our confirmative valuation outcome. Our target share price of 90.57 Swiss francs reflects the intrinsic value of the company, derived using fundamental three-stage economic value-added model and confirmed by a relative EV/EBITDA multiple approach. In our target price estimation, we started with estimation of weighted average cost of capital. We calculated capital structure of the company, as well as cost of debt and equity, resulting in 5.6% WACC. To derive enterprise value, we calculated capital invested in the company, economic value added for 5 years, and terminal value using Gordon growth model. When discounted and added, these elements comprise total return available to creditors and shareholders. Finally, we divided the derived equity value by the current number of shares outstanding to arrive at our target share price of 90.57 Swiss francs.
To check the correspondence of our fundamental approach and market view on the stock, we compared Nestle with its peers using forward-looking EV/EBITDA and price-to-cash flow multiples. Having defined our peer group, we derived target price ranges which are in line with our fundamental approach. We also applied a Monte Carlo simulation to show the influence of stochastic factors on our model. As key inputs, we have used bear and bull scenario analysis, WACC, terminal growth rate, and marginal tax rate for the company. Having run 500,000 iterations, we observed a 60% probability of a buy outcome.
To complete our analysis, we identified the potential risks which could influence our recommendation. We grouped them into 5 main categories: economic, market, legal, operational, and financial risks. Our research showed that deterioration of economic conditions, private label expansion, and reputation impairments are the most probable and impactful risks for the company. Volatile economic conditions can create a number of challenges for Nestle's further development, especially in emerging markets. Upcoming recession and the US trade disputes with China, Europe, and Mexico may lead to high inflation rates, slowing economic growth, and falling consumers' purchasing power. Nestle hedges this type of risk by having diversified product portfolio and implementing business resumption plans.
Market risks deal with top-branded products, which are becoming substitute to multinational brands. Over 65% of consumers consider private label products to be a good alternative to name brands. However, Nestle manages to effectively mitigate this issue by strengthening every product line with niche offerings in compliance with recent shopping trends. Finally, such global companies as Nestle are inclined to face provocations, fake news, or even undergo lawsuits which can affect the share price. However, Nestle has an immediate public reaction to any accusations and quickly refutes fake news. This allows the company to effectively mitigate all the reputational issues.
To sum up, with strong competitive positioning, stable financial performance, and confirmative valuation with limited risk influence, we are very confident of our buy recommendation. We invite you to upgrade your investment portfolio with a stable share and permanent dividend payments. Think long term. Choose Nestle. Thank you for your attention. The team is now open for questions.